Today, we're walking through 5 often overlooked reasons why life insurance can still play a critical role in retirement, especially if you're thinking about canceling or cashing in an old policy. And no, I'm not talking about taking withdrawals from a life insurance policy to help with retirement income, as many of you have probably been told before. This isn't a sales pitch. At first glance, life insurance might seem unnecessary once the house is paid off and the kids are off to college and your retirement accounts are in place. But here's the truth. Life insurance can solve financial problems you may not even see coming, especially during some of the most emotionally and financially vulnerable moments in retirement. Let's walk through what those are and why keeping that old policy might be one of the smartest decisions you make. And just so we're clear, I'm not here to sell anyone life insurance. There's no product pitch in this video. I simply believe that in a world focused on all sorts of complicated investments and tax strategies, life insurance is an overlooked but crucial piece of your retirement and estate planning picture. So stick around to hear a few things you may be surprised to learn about life insurance. Hi, I'm Rob, certified financial planner and fiduciary, here to help you avoid big mistakes and capitalize on opportunities. Reason number 1, losing a spouse has a hidden impact on your finances. When a spouse passes away, many retirees are caught off guard when that extra Social Security check disappears, or maybe a single life pension that ends. But here's what surprises people even more. Expenses don't go down nearly as much as you might think when a spouse passes away. The mortgage might be paid off, but your regular expenses don't change a whole lot. You're still paying for the same utilities, property taxes, home services, transportation, and more. So now you've got less income, but you still have a similar cost of living. Take that Social Security example. If you and your spouse were each getting $2,500 a month in Social Security when one spouse passes away, that's $30,000 a year of guaranteed income that just disappeared. Over just 10 years, that's $300,000 that's now missing from your retirement plan. Not only that, but if the spouse that passes away is the one that mowed the lawn, fixed things around the house, or did all the cooking, now you're looking at having to pay someone for those services if you don't want to, or maybe can't do them on your own, and these services can really add up. Hanging on to that old policy that you didn't think you needed anymore might be the perfect tool to fill the gap. And if you've had the policy a long time, it may even be paid for, not requiring any additional premiums. If you're still paying for your policy, reach out to your life insurance agent and ask them for an in-force illustration to see if you're able to stop making premiums. Traditional long-term care insurance is expensive, and if you never need it, the money's just gone. It's what I call a use it or lose it policy. But today, some life insurance policies come with long-term care or what are called chronic illness riders. These hybrid policies can let you tap into the death benefit while you're still alive to pay for things like home care, assisted living, or nursing facility. Genworth states in a 2022 study that 7 out of 10 seniors likely will need some sort of long-term care, and having a plan to pay for it matters. Here's a quick example. A life insurance policy with a $250,000 death benefit might pay $5,000 a month for up to 4 years towards the cost of long-term care type of expenses. That's $240,000 available to you without touching your other investment accounts or taking extra withdrawals from retirement accounts that can also lead to extra taxes. So before cashing in that old policy, again, talk to your insurance agent. You may already have this benefit and not even realize it. And if you don't have it already, sometimes there are options to exchange the existing policy for one with different benefits. This strategy may or may not make sense for you, but again, it's well worth asking your financial planner or insurance agent about your options. If you're going down this path, I recommend working with someone who is a fiduciary, someone who is not a captive to any one particular company. You don't want to talk to your State Farm agent about this sort of thing. Find someone you trust or someone your advisor trusts to deliver a comprehensive analysis of what is or is not appropriate for you. Next up, here's something that a lot of people miss. There's a common misconception that no matter what you do with a life insurance policy, it's always going to be tax-free. But the truth is that if you go to cash in that policy, that's not necessarily the case. This is much different than when somebody inherits the life insurance death benefit after your passing. So if a policy has grown in value and you decide to cash it in, you're likely going to owe taxes on the gains. But another mistake that people make with these life insurance policies is thinking that these gains are going to be taxed at long-term capital gains rates because, hey, I've had this policy for 20 or 30 years. But unfortunately, that is also not the case. If you cash in your policy and you have gains, meaning the difference between the premiums that you paid in and the cash value of that policy, you're going to owe ordinary income tax on those gains. Ordinary income tax is typically at higher tax rates than what your long-term capital gains tax rates typically come in at. Let's go over a quick example. If you paid $100,000 into a policy and now the cash value is $250,000, you'd owe taxes on the $150,000 of gain. And again, this is ordinary income taxes, not long-term capital gains rates. And let's just say that your combined federal and state tax rate comes in at 30%. Well, 30% on $150,000 is $45,000 lost to taxes right off the bat. Ouch. There are smarter ways to access or leverage that policy without handing over so much to the IRS. So think twice before listening to that stockbroker or investment advisor who's encouraging you to cash in the policy just so he or she can end up managing the money for you and charging a fee. Throughout life, we accumulate all sorts of assets. Many of these assets, like real estate, annuities, IRAs, or small businesses, can be difficult to sell quickly or come with big tax consequences when we want to use the money. If the majority of your wealth is tied up in these assets, especially real estate and small business ownerships, your estate could run into what we call a liquidity problem, meaning it doesn't have enough cash or non-retirement stock accounts to immediately provide for your family after your passing or cover the necessary expenses that come with settling your estate. These can lead to forced sales or short sales of property or businesses that you worked a lifetime to accumulate and patiently wait for it to appreciate in value. Life insurance can help solve this by creating what we call liquidity. It delivers tax-free cash to your beneficiaries usually within just a few weeks. The money is then immediately available to support your loved ones and can help cover funeral costs, estate taxes, or basic living expenses without forcing your family to sell property or take big taxable distributions from retirement accounts at the wrong time. It's one of the cleanest ways to keep your spouse or children out of financial stress during a difficult time. And finally, yes, life insurance is truly tax-free for most people. Unless your total estate is over $14 million individually or $28 million as a married couple, your life insurance payout to your beneficiaries is completely tax-free. Here's how it works. When your spouse or parent passes away, the beneficiary contacts the insurance company, answers a few basic questions, submits a death certificate, and chooses how they want the money. Check, direct deposit, lump sum, that's it. as long as the beneficiaries were up to date, because that one simple paperwork error can cause delays or complicate the payout. So you always want to make sure that you keep your beneficiaries on your life insurance policies accurate and up to date. There are very few assets that pay out this easily in cash without any tax consequences to worry about at all. Not to mention the ease at which you can divide the funds between multiple beneficiaries. It's easy to think that life insurance is just for the young, but in retirement, it can still protect your spouse, replace income, help your estate, and your legacy. Dropping it too soon might leave your family scrambling for cash at the worst possible time. Now, I know we covered a lot of information in today's video. If you're wondering how we might be able to help you, take a look at your life insurance situation to see if what you have is appropriate or what you need or what you don't. We'd be happy to chat with you. If you're interested, there's a link in the description below. And if you enjoyed this video, don't forget to subscribe for more videos just like this, helping you navigate your way through retirement.